This is the sixth video in this series entitled When to Hire a CFO. Thank you once again for joining us. I know that there is a lot of information in this series. I appreciate your persistence in learning how to assemble your financial dream team. Let's continue by reiterating what a chief financial officer is. The CFO fulfills the critical role of planning and facilitating the successful financial future of the company. Let's take a moment to think about this in a very pragmatic way by reviewing the roles of the other financial team members. The bookkeeper is inputting the historical financial transactions of the company into the accounting software. The accountant is ensuring the data entered by the bookkeeper is correct. The accountant is also ensuring the more complex financial transactions of the company are entered into the accounting system. Transactions such as entering the purchase of equipment, land, and buildings. Depreciation schedules are created and updated by the accountant. The monthly or quarterly process of closing the books is attended to by the accountant as well. Turning now to the role of the financial controller, we stated in a previous video that the controller is your internal financial watchdog. Please recall that the controller ensures the financial reports prepared by the accountant follow all the accounting rules, the government rules, and any industry-specific rules. Tax compliance and internal audits are the responsibility of the controller. The controller will also ensure proper practices are followed to prevent fraud. The controller provides detailed financial data and internal reports to the CFO. Important to note about the roles of the bookkeeper, accountant, and controller. They all attend to the historical actions of the company. None of them are forward-looking. This is a critical detail and why the chief financial officer is part of your C-suite. The CFO is helping you plan, forecast, and measure the financial performance of the company. Once again, think about the realities of running a company. The founder or founders of the company typically attend to the day-to-day operational needs. To be more specific, the founder and owners of the company are probably very busy attending to getting business in the door, delivering a great product or service, managing customer relationships, managing vendor relationships, paying bills, collecting money, keeping enough money in the bank account to pay the bills and fund the company growth, also dealing with the business bankers to finance growth. All of these tasks and many more are just to attend to the daily operations. Also of critical importance, although often left undone, are the tasks your CFO will do, such as 1. Forecasting and managing cash flow. If you run out of cash, your business stops and can even close. 2. Comprehensively viewing how the company will borrow money for operations, equipment, and buildings. This lack of planning will often result in paying much more in interest expenses for everything the company finances. 3. Developing and following a comprehensive financial plan. Often, the lack of a comprehensive business plan results in business owners and managers being very busy but not productive. To be more specific, there is a huge difference between being busy and being productive. Busy is just activity of any kind. Being productive requires spending your time and effort on tasks which bring you closer to achieving your business and personal goals. A best practice is having an annual 1 to 3 day planning meeting during October or November. This focused meeting is needed to dive deeply into what happened during the current year and determine the most profitable path forward for the next year. The big companies do this, at times fanatically. Companies with less than 200 employees often do not and suffer the consequences. The most important role the CFO plays is providing real-life, real-time financial analysis and recommendations. Please give in-depth consideration to how important this is. The CFO is often the only person in the company who truly understands the forward vision of the company and the in-depth details of the financial activity. A great CFO can operate at the 30,000-foot level and at ground level with equal comfort. It bears revisiting what real-life, real-time financial analysis and recommendations look like. On an ongoing basis, typically monthly, although twice a month is even better, the CFO will provide forecasted to actual reports. These in-depth reports detail what was projected in the business plan and what happened in real life. More specifically, what happened with the company revenue and expenses. The report begins with a column of numbers labeled forecast. Next, a column of numbers labeled actual pulls numbers from the financial statements and is placed next to the forecasted numbers. Two additional columns reveal the difference in the forecasted to actual amounts as a dollar amount and as a percent. Another column labeled favorable or unfavorable reveals if the amount shown in the actual column was beneficial or detrimental to the company. Only by diving this deeply and this often into the company's goals and financial situation can financial harm to the company be avoided and great opportunities be seized as they present themselves. If any of these critical actions are going undone or are not done properly and regularly, the time is now to give serious consideration to hiring a CFO. Before we get into the cost of hiring a CFO, let's look at some additional indications that it is time to hire for this important position. 1. The financial complexity for your company has grown. Examples of this could be need for revenue analysis. You have growing sales, but you are not sure if each job or sale is profitable. A need for funding analysis. You are in need of a comprehensive strategy to fund the company's current and future needs. Funding may be from business lenders or investors. Of course, you want to pay as little in interest and fees as possible. The CFO will figure this out. Next, current financial systems and data gathering may not be the best solution. As your business has grown, your accounting system does not provide ease of use or the reports needed. Managing inventory, job costing, product costing, accounts receivable, accounts payable, loans, employee costs, revenue, expenses, profitability could all be better. Uncertainty about local, state, and federal taxes. You are hoping you are paying all the taxes required and no more, but you're just not sure. 2. Another indicator it is time to bring on a CFO is uncertainty regarding current and planned growth. Examples include you are expanding your products and services, but need to ensure you are charging enough to make the growth pay off. Knowing the operational cost of growth. How much precisely will it cost to grow the company with employees, supplies, and equipment? Another indicator is your financial team is growing or should be. Examples such as you may have a staff bookkeeper or accountant, you may even have a controller. Your financial team needs to be led by somebody other than you who understands the company vision and accounting. Indicator 4, the founder or owner workload is excessive. Indications are you have too many tasks to run company operations and properly attend to the in-depth financial matters of your company. Or the company goals and growth require a financial expert to delegate the responsibility to. Our fifth and final indicator is that the owner's skills, education, experience, and interest are not centered around the numbers. Focusing on skill sets for a moment, if you're like most company leaders, your background is probably not as an accountant or controller. Turning now to formal accounting education, most company leaders have never had any formal accounting education. Perhaps you had a few accounting courses in college at most. You know that a great CFO needs to have extensive accounting education and experience. Another reality is that most business owners prefer to spend their time in business activities other than accounting and forecasting. Very few owners enjoy getting into the weeds of every financial transaction and how those transactions work their way to the financial statements. An obsessive-compulsive bean counter with a vision and leadership skills is the person for the task. Those particular people make great CFOs. Let the CFO do what they do best, bring the necessary information to you so you can run the overall company operations. Beyond these specific indicators, pay attention to the overall health and trajectory of your business. Are you facing financial challenges or missed opportunities due to lack of financial expertise? Is your leadership team struggling to make informed decisions based on financial data? If so, it's likely time to consider bringing in a CFO. Remember, hiring a CFO is an investment, but it can pay off handsomely in terms of improved financial performance, strategic decision-making, and overall business success. Don't wait until you're in a crisis to make this critical hire. The next video segment will address salary ranges for your CFO. Advantages of having the CFO be a W-2 staff position versus a 1099 outsourced position will also be discussed. See you again soon.